Hi, this is John Andres from optionsmeister.com. I want to welcome you to my course on executing and managing the short strangle. In this course, I will introduce you to a very popular option strategy, the short strangle. I must assume that the author of the name of the strategy, short strangle, selected the name from his interpretation of the visual from the risk graph shown on this slide. I would encourage you not to get hung up on the name or any of the other names associated with option strategies. I have often thought that the strange names for many of the strategies is to confuse the novice trader and discourage them becoming a self-directed investor. The illustration that you see on the slide is the risk profile for the short strangle. Many traders like to use the risk graphs to aid them in visualizing the risk-reward on the trade. I mark strikes of the short put and short call on the risk graph. The green shaded area is where the trade is profitable. Where the arrows penetrate the zero line are the break-even strike. We construct the short strangle with one or more short calls, and one or more short puts, on the same security in the same expiration cycle. We can construct a short strangle with an unequal number of short calls and short puts, especially when the trader wants to skew the trade either to the bullish side or the bearish side. In most short strangle trades, the number of short calls is equal to the number of short puts. In the short strangle, we place the short calls and the short puts at out-of-the-money strikes. I should duly note that a short strangle is an undefined risk trade. What does that mean? It means that the trader has unlimited risk on either side of the trade. And that keeps many traders from using the short strangle. While I cannot deny the unlimited risk of the strategy, I will point out to you, later in the course, why the short strangle is far and away my favorite strategy. In this slide, I want to introduce you to the normal distribution curve. While the math behind it is very simple, it is of utmost importance that you indelibly etch this in your brain. The entire basis of the short strangle trades I execute relies on the probabilities presented on this simple tool. Let me touch on the basics now. As you can see on the chart, the one standard deviation range contains price 68.3% of the time. You may ask, what does that mean? Very simple, if we put on a short strangle where the short call and the short put are placed at the one standard deviation strike, there is a 68.3% probability that price will remain within those two strikes for the duration of the trade. Same goes for the two standard deviation strikes. 95.5% of the time, price will stay between those strikes for the duration of the trade. And while we rarely trade a 3 standard deviation strangle, it will contain price 99.7% of the time. The basis of constructing strangles, in my world, is wrapped around the statistical probabilities that you see on the distribution curve in this slide. As an option trader, you need to gain an innate knowledge of the most important Greeks, delta, theta, gamma, vega and, to a lesser extent, RHO. When evaluating potential trades and adjustments, the most important Greek is delta. They define delta as the amount of change in the option's price for a $1 change in the security's price. We also use delta as a back-of-the-napkin way to define the probability of the option strike to expire in the money at expiration. Deltas also are used to reflect the bias of an individual trade or an entire portfolio of stocks and ETFs. The delta of a call is a positive number. The delta of a put is negative. That should make sense to you because if you buy a call, you are expecting the stock to rise. Conversely, if you buy a put, your bias is for the stock to drop in price. This slide will familiarize you with the option chain and specifically delta on the option chain. The calls are on the left side, and the puts are on the right side. I highlighted the delta column for both the calls and the puts with a green rectangle. In this example, let's assume the price of the underlying financial instrument is $150 per share. What I illustrate on the slide is basically a 1 standard deviation strangle. When this slide was created, the 165 strike call was the closest call to the 16 delta. The 135 strike on the put side was closest to the 16 delta put. This action would create a 1 standard deviation strangle. The 16 delta strike on the call side and the 16 delta strike on the put side, each has a probability of 84% of remaining out of the money at expiration. I am often asked, then how do you come up with the 68% for the 1 standard deviation range? Take 100% and subtract 16% on each side. Therefore, 100% minus 16% equals 68%. Again, in this example, a 1 standard deviation trade would sell the 165 call and sell the 135 put. The 165 call has a delta of 19. The 135 put has a delta of minus 17. Remember that calls have positive deltas and puts have negative deltas. Refer to the screenshot of the sample trade on the right side of the chart. A short strangle trade would sell the 165 call and the 135 put. The 165 call has a delta of 19. The 135 put has a delta of 17. We calculate the initial delta of the trade this way. In this 1 standard deviation short strangle, we are selling the options, not buying them. Because we are selling the options, we multiply the delta of each option by -1. At the time of trade execution, the call side would be short 19 deltas. The put side would be long 17 deltas. The delta of the trade is calculated by adding the long 17 deltas to the 19 short deltas. The obvious answer is -2 deltas. It is important to note the difference between the delta of a stock or ETF and the delta of an option. The deltas for options are dynamic as they are constantly changing because of the change in any of the key components that generate the price of the option. Those components are, price of the underlying security, implied volatility of the underlying security, days to expiration for the option, risk-free interest rate. To calculate the net deltas of a position, simply total all the deltas. The net delta of a trade will show whether the trade has a long bias, a short bias, or a neutral bias. If the net delta position is positive, the trade has a long bias. If the net delta position is negative, the trade has a short bias. The delta of a security instrument is static. 1 share of stock equals 1 delta. If the trader buys 100 shares of stock, he creates 100 deltas. The delta value of the stock never changes. When the 1 share of stock is sold short, the short share of stock has a delta of -1. The sale of 100 shares of any stock or ETF will create -100 deltas. The net delta of any trade provides the current bias of the position. We start most strangles with a neutral bias. We also use the deltas of a trade to provide us with a back-of-the-napkin probability of the trade expiring in the money or out of the money. Refer to the sample trade in the option chain on the right. The call side would have a 19% chance of expiring at or above the 165 strike. The put side 135 strike would have a 17% chance of closing at or below that price at expiration. To calculate the probability of profit for this trade, start with 100% minus 17% minus 19% equals 64%. Understand that our using deltas of a trade to calculate probabilities is really a quick, back-of-the-napkin approach. Complicated formulas, Black-Scholes being the most common, precisely calculate the exact probabilities of a trade. Most option chains have probability in the money and probability out of the money metrics available to display. However, for the retail trader, using deltas for probabilities is quick and adequate. We place short strangles and implied volatility rank is 25% or higher. We place short strangles between 25 and 60 days to expiration. Short strangles are exited or adjusted as needed when the trade has 21 days to expiration. Short strangles are closed when the debit to close is 50% of the premium collected. Some traders will exit strangles if they can collect 25% of the premium in 7 days or less. Less than 25% of strangles will need some kind of adjustment. Simple adjustments are rolling out the strangle one or more expiration cycles for a credit. Less than 5% of short strangles, executed per the probability-based criteria, will require more excessive adjustments. The short strangle is typically a delta-neutral trade. The call delta and the put value have the same value and cancel each other out. 16 positive deltas plus 16 negative deltas equals 0 deltas, the trade is delta-neutral. But what is a trader to do when the short strangle goes wild? First, be calm and mechanical. Manage the overall net delta position of the trade. Do not micromanage every minor change in the price of the security. This will lead to being whipsawed. Many new traders tend to freak out with every move in the price of the underlying stock or ETF. Constantly adjusting a trade is a recipe for inconsistency. Remember, markets move. If you trade, expect to encounter what I refer to as trades gone wild. If you accept you will have your share of these trades, then learn how to deal with them mechanically and without emotion. Many times your trade will show an unrealized loss, even though price has remained between your short strikes. Most often, the cause is an increase in the security's volatility. If the price of the underlying remains between the short strikes, remain patient and mechanical, there is no reason to adjust immediately. Should the price of the security near one of the short strikes, but without breaching that strike, you may choose adjust by neutralizing the deltas by 50%. Neutralize by 50% simply means roll the untested side to the strike that has a delta of 50% of the strike of the tested side. I would caution you that if rolling the untested side to neutralize deltas by 50% results in a tiny increase in premium, then wait. There is no reason to tighten the spread without being paid appropriately. If one of the short options is breached, take aggressive mechanical approach to adjusting the trade. Only adjust the untested side. Roll the put up, or roll the call down. The first and best adjustment is to roll the untested side to a delta that is approximately 50% of the tested side delta. Strangles that are one standard deviation or wider require adjusting less than 20% of the time. Most of those strangles that require some adjusting need simple modifications. Then you will encounter strangles that have not just gone wild, but have really gone wild. When the trader faces a strangle that has moved well beyond one of the short options, the trade requires aggressive, but still mechanical adjustments. Beyond the common adjustment of rolling the untested side to a delta value at is 50% of the tested side, it may be necessary to create an inverted strangle. We create an inverted strangle when price breaches the short call and the short put is rolled to a strike above that of the call, or when the short put is breached and the short call is rolled to a strike below the price of the short put. When a short strangle becomes inverted, the trader has mitigated the loss, but must realize that a potential loss is locked in. The intrinsic value of the inverted strangle is the spread width of the trade. The extrinsic value is the current price for the inverted strangle less the intrinsic value. The option chain on the left is the standard 165 by 135 short strangle. Price remains between the short strikes. The chart on the right assumes that price has breached the 165 strike, making it necessary to roll up the put above the short call and creating a 175 by 165 inverted strangle. Currently, the spread width of the inverted strangle is 10 points. The very least amount to close this trade is $10 if the price of the underlying is between 165 and 175 at expiration. Most of the time, an inverted strangle can be closed for about $10.25 on expiration day. If you don't close the trade, most brokers will exercise both sides for you. They will charge you the spread width to close the trade. Some brokers will add an assignment fee for each leg. Important considerations with the inverted strangle. In regular short strangle, where the call strike is above the put strike, there is the potential that both options will expire worthless. With the inverted strangle, if price stays between the short strikes, the minimum cost to close the trade is the spread width. The intrinsic value of the 175 by 165 inverted strangle is $10. That equates to $1,000 for each one contract lot. The current value of the 175 by 165, shown on the previous slide, is $26.80. Therefore, it would cost $2,680 to close the trade at this time. The extrinsic value of the 10.00 wide inverted strangle is $26.80 minus $10 equals $16.80 or $1,680 per each one contract lot. Assuming the goal of the traders is to minimize the loss or even make a profit with the inverted strangle, it is incumbent upon the trader to accumulate premium in an amount equal to or greater than the spread width. Each subsequent adjustment of the inverted strangle should generate additional premium or narrow the width of the inversion. If the trader can narrow the width of the inversion and pick up some additional premium, even better. Managing an inverted strangle is materially different from managing a conventional strangle. When we adjust a regular strangle to create an inverted strangle, the die is cast, so to speak, and potentially a loss has been locked in. The reason a loss is potentially locked in is now the absolute best exit on an inverted strangle is the spread width of the position. In the short 175 put and short 165 call inverted strangle that we looked at earlier, the minimum amount to exit the position is $10 per contract. For many traders, there is the urge to micromanage the inverted strangle. It is not comfortable watching a significant unrealized loss on your platform. What is of paramount importance to understand about the inverted strangle is there are no adjustments to do as long as price stays between the short options. You must exercise patience and allow the daily theta to come out of the trade. It does not matter if the price of the underlying spikes up or down and the loss on the trade is gyrating wildly, as long as price stays within the strangle. It is not uncommon at a $10 wide inverted strangle shows a debit to close the trade of $15 or more. The longer the trade has to expiration, the higher the unrealized loss you should expect to see. Understand that the trade will eventually come in all the way to its intrinsic value. The goal of the trader in managing the inverted strangle is to accumulate as much or more premium than the spread width of the inversion, narrow the width of the trade or both. When the trader has collected enough premium to cover the spread width, he or she has managed the trade successfully. The option chain on the right side of the slide is an actual snap 80 by 70 inverted strangle. Note, the delta and theta values are reversed because it displayed the closing order to generate the current price of the inverted strangle. The current metrics for the position are: the price of snap is $75 per share. The current price to close the position is $16.85. The intrinsic value of the 10-point wide inverted strangle is $10. The extrinsic value is $6.85. That is derived by taking the current price to exit the inverted strangle, $16.85, and subtract the intrinsic value of $10. There is $17.92 per day in theta decay. The delta of the trade is negative 7.27. Place a good until cancelled order to close the trade for $10.25 plus or minus. By having a working order for slightly more than the width of the inverted strangle, we can monitor the trade daily. As long as price remains between the short 70 call and the short 80 put, no adjustment is necessary. When the mid price to close the position nears the price of $10.25, it is time to adjust. Here is the proper way to adjust the trade. Roll the inverted strangle out one or more expiration cycles. Do not increase the width of the inversion. Reduce the width of the inversion if possible, but only for a credit or zero. Do not add more capital to the trade. This example is a buy-do 155 by 150 inverted strangle. There are 20 days to expiration. The current price of buy-do is $162 per share. Note on the bottom of the chain at the price to close this 5-point wide inverted strangle is $17.85. The intrinsic value of this position is the width of the inversion, or $5. Because the price has breached the short 155 put, the extrinsic value is a huge $12.85. The daily theta of the trade is negative 46.33 deltas. Price having breached the short 155 put on a strong up move in by do necessitates an adjustment. When adjusting an inverted strangle, the goal is to roll out for as short a period of time as possible for a zero or credit. The implied volatility of buy-do is elevated, which allows the current position to be rolled out 1 week. We are able to roll up the inverted strangle to higher strikes, recenter the price and retain the $5 inversion for a credit of $2. There is nothing else to do with this position as long as price stays between 160 and 165. Set up a good until cancelled order for $5.25 debit and monitor the position for two potential outcomes. 1. Price stays between the two short options, do nothing. 2. When price breaches either short option, adjust the trade in this manner. A. Roll the inverted strangle, re-centering the price while maintaining the spread width for a credit or zero. B. Narrow the width of the inverted strangle, if possible for a credit or zero. C. Adjust the trade to the shortest amount of additional time. Summarizing the execution and management of the short strangle. A strangle is the simultaneous sale of an out-of-the-money call and an out-of-the-money put, in the same underlying, in the same expiration cycle. The strangle is an undefined risk trade. Delta is an important metric in executing short strangle trades. We typically sell the short call at a delta of 20 or higher, and we sell the short put at a delta of 20 or lower. The short strangle has two break-even price points. On the call side, add the amount of total premium collected to the strike of the short call. On the put side, subtract the amount of total premium collected from the strike of the short put. In one standard deviation strangles, price remains between the short call and the short put 68% or more of the time. When a strangle goes wild and necessitates adjusting to an inverted strangle, always adjust the trade so to receive additional premium, without increasing the width of the inversion. Never add additional capital to the trade. A few facts about short strangles. Most short strangles are delta neutral. Short strangles are undefined risk trades. Brokers establish the risk of a short strangle, for buying power reduction purposes, at approximately the 2 standard deviation level. Depending on your bias, short strangles can be skewed either by delta, or by the amount of premium collected, on the short call versus the short put, in this manner. Remember, the higher the delta of the option, the closer the strike is to price. If you have a bullish bias, place the short put option at a higher delta, which would be closer to price, than the delta of the short call. You can also skew the short strangle by selling more puts than calls if you are bullish. If your bias is bearish, place the short call option at a higher delta, closer to the price of the underlying, than the delta of the short put. You can sell more calls than puts, if you are bearish. Thank you for purchasing my course, Executing and Managing the Short Strangle. I hope that the course brought a little clarity to trading the short strangle, and you picked up a few nuggets along the way. On this slide, you will find my contact information and the links to some of the content that I have created. If you have not joined the OptionsMeister Facebook group, I would encourage you to do so. It is free to join. And I provide content and help traders with their trade-related questions. Also, please subscribe to my YouTube channel, and you will receive notification when I post new trading videos. Finally, if you are an active options trader, you may have an interest in my gold level membership. It includes a live trading room and 2 private Skype groups. I post all my new trades throughout the trading day in real time. I also post all exits and adjustments in real time. I am available throughout much of the trading day, so you have access to me for any trade-related questions. If you would like to speak with me, my phone number is 513-518-6666, and I answer my own phone. I would be happy to speak with you most anytime. I love talking with other traders. I am in the Eastern Time Zone. If you have Skype, send me a contact request. My Skype ID is John A_FLA. Good luck and great trading.